Hello, I'm Bernard Hickey from interest.co.nz and welcome to another in our series of double shot interviews where we bring in some sort of newsmaker, CEO, minister, someone who's looking at something interesting that's happening in the world, and there's nothing more interesting in the world right now than the currency wars. And we've got Chris Weston here from IG Markets. Welcome to interest.co to talk about the turmoil on global financial markets, and I've never seen it, apart from a couple of years ago, so tumultuous.
Yeah.
What are you seeing on particularly the big currencies that are moving at the moment? What are the trends? What's the action? Where are people popping their money?
Well, I think that's, the interesting question. I think you just hit the nail on the head by that single word, trend. They have been trending extremely well. Just everyone wants to sell the US dollar at the moment. It has been completely out of favour. It has been, looking at countries that are potentially restricting the growth, not trying to expand their balance sheet, and the euro's certainly been in that situation. The Australian dollar's had a really nice run up to where we touched base last night, about 99.19. Obviously, they're looking very much at the growth projections coming through there, the fact that we're going to come into surplus next year, the fact that on the other side of the equation, not just a strong Australian dollar, you've got a very, very weak US dollar, and you've got this whole race to see who can devalue their currency the quickest, basically. So, yeah, very, very interesting times. Just the way that currencies are trading at the moment is very interesting. If you look back to historical pre-GFC, it was very much currencies were a leveraged play on inflation. So you just basically had one economy playing off against the next. Better data would result in that currency appreciating. Then we had the GFC, where basically currencies would trade in their own right. It would be a risk-on, risk-off trade. So better than expected data in the US and around the world would result in the euro, sterling, Australian dollar, commodity currencies all rallying and the US dollar being sold off. If we had negative data, we'd have a situation where the dollar would come into play because people were looking for safe haven. And now we've got a very different situation where people are trading around quantitative easing. So very much just a one-way trade. Better than expected data gives rise to risk in currencies, so you get a good rise in the euro, the Australian dollar, the Kiwi dollar, the commodity currencies, for example, and then you get worse than expected data, sees the US dollar selling off as well, because you've got a situation where people are saying, well, we've got a heightened chance of getting quantitative easing. So it's just the way that currencies are trading at the moment. You've got to keep your eye on the ball and work out how they're actually working. But yeah, we've had a very, very nice uptrend in the euro from about 118 up to where we are now, touching the 140 mark last night. So, it's just been a very, very easy trade.
And the key thing is this area of quantitative easing. What are the signposts, what are the milestones we should watch out for in the next few weeks or months around quantitative easing?
Well, I think there is a large element priced into the dollar at the moment. If you look at bond yields at the moment, they're touching record lows on the front end of the curve as well as the back end of the curve. If you look at short end bonds against Treasury inflation tips at the moment, they are pricing a large element of quantitative easing. I think Deutsche has said somewhere between $350 to $600 billion has actually been priced into markets at the moment. So, are we going to get quantitative easing? The market is certainly suggesting we certainly are, as soon as the FOMC meeting in the 3rd of November. Now, my situation to viewers and to people who are trading currencies is perhaps we could get this kind of buy the rumours, sell the facts scenario. The dollar has had a massively, well, I wouldn't say massively undervalued, but it is undervalued at the moment. It has had a good run on the downside. Perhaps if the FOMC do come out and announce it, we could get some dollar appreciation as people actually, come out and say that most of it's priced in.
Some people are saying that now is the time for global coordination of currencies, for some sort of new Plaza Accord. Back in 1985, the Americans and the Japanese and the Germans all got together and decided to devalue the US dollar against the yen. Is there the chance of some sort of meeting which comes up with a new Plaza Accord?
Well, I'm not sure about that. I think the US dollar is still the reserve currency of choice, and I think it will be for some time now. There's been all talks about the Chinese getting together with the Europeans, Russia getting together with the French and talking about potentially having this new global currency. People have even talked about the renminbi, the yuan, being a currency of choice further down the line. I don't see it happening anytime soon. It's very, very expensive to do that. It's going to take a long time to initiate. I think we've just got to get over a situation where the US economy starts growing a lot better, and we're looking for about 2.5% growth from the US next year. Companies still got a lot of cash, so hopefully we're going to see that being put to work, and we're going to get some good growth coming through. We just need some job creation. Once that confidence comes back in, people will be looking at the US dollar as the continued reserve currency going forward. So I wouldn't be reading too much into that just at the moment.
So through this talk of quantitative easing, a lot of people have been jumping into commodities. Anything that's got something physical to it,
That's right.
Not made of that old fiat currency paper. What are you seeing on those commodity markets? Where are people jumping? How are people trying to take advantage of it? What's the scene out there?
Well, I mean, it's what we call the currency debasement trade. People just saying, right, well, every country out there, you've got the UK potentially doing further QE, you've got the Japanese, cutting their rate as well as intervening in the currency market. The US obviously going down the QE route. Europe hasn't really voiced an opinion for their strong currency, but they obviously want a weaker currency, and people just want to hold something tangible. That's what we've seen in gold, we've seen that in silver breaking through, copper as well, trading up to $3.70 per pound plus. And just people have just been wanting to hold gold, and there's only one way to trade gold. You're either neutral, three ways to trade gold. You're either neutral, you're long, or you're very long. You'd just be a fool to go short, basically. But people have been buying the underlying commodities via futures, via CFDs. In the actual real market, the big drivers obviously being futures positions. But we've seen a lot of business on the speculative side as well. Some of the smaller companies, your Mount Gibsons, your Cobar Resources, these kind of silver stocks, and Mount Gibson's an iron ore stock. But some of those like Atlas Iron, something with what they call higher beta names, where they generally, if the market's having good confidence, they'll outperform the market. So names like Mount Gibson, Atlas Iron, we've seen quite a lot of business, because generally when the market's up 1-2%, because the commodities have been rallying, these stocks will be up 3-4-5%. So they're just looking for that outperformance. So some of the smaller cap names in the mining sector we've seen quite a lot of business, and they've been doing very, very well recently as well.
And in Australia, there's quite a range of these speculative mining stocks, including in copper and some other of the minerals.
Yeah, that's right. I mean, we've got so many of these little tiny speculative companies, and they're a great place to be. I mean, you've got if you are looking to trade some of these companies, you've got the first thing you want to look at is who's the management. Have they got a management that's been recognised? Do they also have enough cash? What's the assets they're holding as well? Because you'll find any of the guys who do research, a lot of these companies, if they are very, very good investments. And the net present value will be trading much higher than where the company, the underlying spot price is at the moment. So you get some good upside if you do your research.
Now, this weekend, there's a big meeting of IMF and G7 finance ministers where the currency wars will be discussed. What should people be watching for to come out of that? Do you think there's the chance that it may drive currencies in one direction or the other come Monday morning?
I don't think it will. I don't think anything necessarily is going to have a big change too dramatically. I mean, I know the Canadians are going to be looking to try and appease markets at the moment. They're the ones who are chairing that. I think it's going to be, let's regress. Let's see what's happening at the moment, and just try and put some calm into global financial markets, because no one wants to see a trade war. No one wants to see a trade war. That would be detrimental. I mean, the US and the Chinese at the moment, well, the US basically branding the Chinese a manipulator of some sorts. Will it go through the Senate? That's the big thing. I think they've got cooler heads, and generally they won't be able to pass that bill through the Senate. But I think they're just going to sit back and say, well, look, global trade wars, they're the devil's work, and we really don't want to be seeing that at all. So just try and put some calm into markets and just trying to get people working together a little bit closer, I think is really what we're going to be seeing.
The tension at the heart of all this is between China and America, with China refusing to allow the yuan to appreciate versus the US dollar. A lot of people are watching what's happening in China, the noise that's coming out of the leadership there. What's the prospect for China saying, fair enough, we'll let it rise, or are they going to stick there and say, no way is it going anywhere?
Well, I mean, I think the Chinese have been very, very prudent managers of capital, if not so the best in the world at the moment. But I mean, they can't, people are talking 20-40% undervalued, the renminbi. Can they let it appreciate that much? They can't. There's no way they do. There'd be civil unrest. There'd just be, their economy would suffer huge consequences. Is it undervalued? Well, most people would suggest it is by some way. But what can they do? I mean, they can let it appreciate, 3-4-5% up until the end of the year, probably going into the first quarter of 2011, and that will appease the Americans. At the end of the day, the Americans are suffering because of this. They're suffering on jobs, but I think what's the most important situation is not so much the US and China, it's the Europeans in China. You know, we're obviously very leveraged, New Zealand and Australia, to China, but the biggest exports and biggest trading partner of China is the Europeans. So I think that's one you've got to look at quite closely. But, you know, I think, you know, the Chinese will want to appreciate the yuan, but they'll have to do it slowly, and they'll do it on their own terms. They're not going to be pushed into it by the US.
Chris Weston from IG Markets talking there about the currency wars. Thank you very much for coming in.
Cheers.
I'm Bernard Hickey for interest.co.nz. That was another in our series of double shot interviews.